Hi, everyone, and welcome to the show. I'm your host, Brian Rogers. And there are many investors out there who aim to generate income by trading options. And some of them may be tempted by the juicy premiums that riskier long shot options may offer. But swinging for the fences isn't necessarily the best approach. And the sport behind that metaphor proves it. Consider the batting statistics for Major League Baseball. Just 12% of hits are home runs. Yes, they're very valuable when they occur, but constantly trying for one could also result in a lot of strikeouts. Meanwhile, about 65% of hits are singles. Sure, they advance players just one base at a time, but a steady stream of them can pile up runs. And that's how games are ultimately won more often than not. The same dynamics can apply to options. A series of modestly profitable, yet consistent trades can work wonders. It's an approach today's guest speaker takes to heart. His options trading plan aims to temper volatility and unpredictability to help earn consistent profits. And he's confident it works in all kinds of market conditions. So let's hear more about it. Joining us is Cody Yeh, founder of Say YEH to Fire. Cody, it's great to have you back on the program.
Hey, thanks for having me again, Brian.
All right, before we dive in, can you share a little bit about how you got into options trading and why you decided to make it your mission to teach others about how to trade?
I don't really share this on any of my public channel, but deep down is because when I grew up, my dad's high income earners. But growing up, we did not experience a high income earners experience. What I mean by that is he makes a lot of money on his full-time job, but because of his investing habits, he did not get the right mindset and education. We actually, our family lost a lot of money in stocks. And growing up, we experienced that. And going through university, I almost couldn't finish second year because that was 2010, and that's when the market crashed and everything just spiraled from there. So that's where I took it to heart, and I know finance is number one thing to take control of, and that is one of the key things that you can get the freedom and the success and just the stability to have a family and enjoy the life. So that's why I work really hard to get that down. Money's not the most important thing, but it's one of the, in my opinion, one of the most important thing to get it right so that everything else will fall in place.
All right, and one of the things I've always been interested in, Cody, is I love the play on words that you have there, the say yay to fire. And it's obviously that's an acronym, but what does the fire stand for?
Yeah, FIRE stands for financial independence and retire early. Now, don't get me wrong on that phrase because I'm not retire. For people who kind of in my state of mind, who reach their financial freedom, most likely than not, they need something to do. And in my shoes, I hit this when I was 29. I own multiple properties. I have a seven-figure account. I have a stable income from just my trading. I also have a coaching program, all that, and real estate portfolio. But I didn't stop here because I know the moment I stop giving back, or the moment I start achieving the next thing, I lost meaning of life, right? So in this case, I know that, I can teach, and I know that I graduated as a mechanical engineer, so I'm really good at processing. So I combine them together and start a YouTube channel, and now have thousands of students and helping them reaching their state of fire so that they can think about what they're going to do next, whether they spend more time with family or spend their time in a different country or just overall, having more freedom.
I like it. I like it. It's not about the finish line. It's about the journey as well. So I do like that. That's
Hmm.
very inspiring. And for those watching, if you're interested in hearing more about Cody's backstory and his approach to trading options, make sure to check out our past webinar with him. It's called Learn How I Manage Risk as an Options Trader, and you can find it in the Learning Center on Webroker and on TD's YouTube page. So now let's turn our attention to today's topic. So just a quick word for our audience before we begin, though. We're discussing Cody's personal approach to trading options that works for him. Take it as perspective to consider for your own approach rather than explicit financial advice. With that said, let's get into it. First off, you primarily trade options to help generate additional income. Why do you feel options trading can be a valuable complement to a stock portfolio over the long term?
This is a great question, Brian. And I break down the reason why I use our said and done strategy, or why do I use option, into three categories. The first one is what I call the quick money, the fast money in a positive way, the medium term money, and the slow money. So my stock portfolio, all the dividends, all the long term growth, long term hold, is the slow money. The medium side is where you can sell puts on individual stocks, but the fast money is where it's kind of like your operational income as a business owner. It comes in every week. It's like your paycheck, like your T4, that keep coming in, and you use that to pay for your lifestyle or for your overhead expense. So our said and done strategy is what I call the fast or the quick money. That's constantly, turning over, making income. So we use that to fund the lifestyle, fund the next investment, or fund a long-term portfolio, right? And then keep investing, keep increasing your nest egg, let it keep snowballing. And that's the whole point. And a lot of people just keep throwing money into investment and live equity rich, but cash poor. And cash poor, you can't really do much in this world, right?
Right. I really like that snowball example. That's a good analogy as well. So interestingly, you like to focus on trading options on indexes like the S&P 500. So rather than individual stocks, why is that?
Index is generally more stable, less volatile. When it pull back less, and it provide really good premium, and that's where the true fast money, the true cash flow is coming from, because you don't have to pick stocks, we don't have to worry about individual stocks going up and down. Sometimes if it's too far, we really can't generate premium from selling puts on them, right? That's why we stick to the S&P 500 future options.
Yeah, that's an interesting thought. And I like how you were saying, those that if you don't know what an index is, remember it's that broad, sometimes it could be a broad index like the S&P 500. There's 500 stocks that the Standard and Poor's group puts together. It's almost like having an instant diversified portfolio without actually having to buy that portfolio. Would you agree with that, Cody?
Yeah, that's the best part, because it's really hard to pick stocks. There's only probably a handful of people in the history has been outperforming performing the market by picking stocks, right? And for average people like myself or my students, they don't want to spend full-time job doing that. Um, to be more safe and still generate consistent income. In my opinion, index is the way to go. When COVID happened, when 2021 happened, my long-term portfolio is down, but my fast money still kept coming in. So when people was at cash is king, when all your money is in a long-term portfolio, where do you come up with cash, right? You need strategy to come up with cash if you want to buy the low, but most people don't have money to buy the low, unfortunately, right?
All right. So, well, what are some of the differences between the way index options and stock options trade?
Index option, if we're talking about future option, then it's cash settle. So there's a bit of a difference, and also if you trade on the future option, if you pick the right expiration days and pick the right vehicle, there's no chance of early assignment, and that gives you a lot more control. That's something called European style option. So you have more of a control, and in terms of your margin, in terms of your account size, and if the market turn really fast, you know how long you have to kind of figure things out, right? It's not like if someone panic on the other side, they assign you, then all of a sudden you hold everything, kind of thing. So if the market turn, we're not back holding anything.
All right. And then I know a lot of investors, there's been an interest recently, even on index ETFs. So I'm glad you brought up that point of the control factor, the fact that you may not get assigned early with that European exercise. Have you ever used index ETFs for this type of strategy, or do you exclusively like to use the index itself?
All of them has their own pros and cons, but the reason why we finally settled on the future option of S&P 500 is because first is the most liquid, second, like it says, European style, so it will not get early assignments, third is cash settle, so it's very black and white, and just overall there's a lot of liquidity and there's a lot of volume, so you can scale up your portfolio easily.
Yeah, so that's a great introduction to the audience. If you didn't know about index options ahead of time, there is more information out there. So, for those in our audience, make sure to watch our webinar, Index Option Trading Strategies to Consider During Market Volatility. I know that's a mouthful, but you can hear a lot more about trading index options. It's available in the Learning Center and on our YouTube channel. All right, so you call your approach to trading index options set and done. I know you mentioned that a little bit earlier. that might have piqued some people's interest. Can you take us through how it works and why you like it?
Yeah, so our set and done strategy is, first of all, is set and done, not set and forget. A lot of my students, like Cody, I feel like is set and forget. It's set and done for a reason because, first of all, we don't have to pick stocks, right? We only trade on two tickers, the future option of S&P 500. And second is really we're always neutral, as in we could be maybe slightly bearish or slightly bullish. We seldom take a directional bet, and we're still selling option. We're selling credit spreads on that. So we're always taking advantage of the theta, like an insurance company or a casino, right? We let the speculator make their bets, but we're always collecting the rigs and collecting the premium. So we take away the part where most people are struggling is picking stocks. We took that away, and our team keep looking at where else are people struggling because we have thousands of students, right? Which ones are top perform, which ones are not. We look at how can we eliminate those risks for people.
All right. So one word that you just said that piqued my interest was risk. So we know options can have an elevated level of risk compared to some investments. I know there are strategies out there that can mitigate risk. I know some in our audience may not be familiar with the idea of spread trades. Can you explain that to us? So how does a bear call spread work, and what are you hoping to achieve when trading one?
Is more about taking a bearish position. Let's say if I think the S&P 500 is going to go down, and we sell a call, and then the reason why I turn it into a spread instead of just selling a naked call is because if you sell a naked call, there's a lot of risks and there's a lot of margin requirements. So we want to cap the margin requirement and we want to cap our risks. So that's why we go ahead and buy a call at a higher strike price. So, there's a big spread between the bear call spread, but the whole idea is that not necessarily I really need to buy that call thinking that the stock price will go up. Is really just to cap my margin requirement and cap my risk while I'm taking on this slightly bearish position.
All right. Yeah, no, I like what you said. You're capping that profit you're going to get, but at the same time, you're minimizing that risk. So that's a great explanation, Cody. Thanks for that. And what about the other side? If we were looking at a put credit spread, can you take us through how that works and what you're hoping to achieve with that?
The credit spread for a bull put spread is very similar, right? Let's say the S&P 500 is at 4150 right now. I go ahead and sell a put at, let's say, 3800, right? So that's what we call all that money. And then I go ahead and buy a put underneath it, and the same idea. Not really, I think the stock price will go down. It's just to cap the risks and also to reduce the margin requirement. I don't like to be paying to play the game. I like to be paid, and I just need to showcase patience. And patience is a great thing because if the probability is on your side, patience will definitely pays you really well.
All right. I know my mom used to say patience is a virtue, and I never understood it when I was younger, but definitely you can apply it to options for sure.
That's correct.
All right, another quick note to our viewers is that if you'd like a refresher on some of the options terminology, I know Cody said this is a little bit more of an advanced webinar, but if you want a refresher on, some of the basic option terminology or even what spreads are, there are videos that are available in our Learning Center. So you can check out our video course using options for beginners. That's available in the Learning Center on Webroker, and it's on TD's YouTube page as well. All right, of course, Cody, no trade is perfect, and there are always potential downsides to consider. So, what are some of the risks with your set and done approach?
Correct. So there's no perfect strategy. There's only higher probability strategy or lower probability strategy. But a lot of times, because we mix up with our human feeling, it might be a different perceived risk and reward. So the way we look at our trade is that if the index, that's the S&P 500, move too fast in either direction, let's say if COVID happened again, it moved 30% down in 1 month, our position will get challenged. So we will have to decide whether we're going to take a loss based on our strategy, right? If we keep winning, 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 like you said, getting on bases, sometimes we have to lose a few points, but we already collect so many points up front, we lose a few points, we call it a day, we'll call it a day, but we do have strategy to when potential we will roll our position. That's a little bit more advanced as well. And we will decide that. And actually our team has been testing. That's the number one thing I asked my team to do is re-back test COVID, re-back test 2018, end of 2018, re-back test 2015, the flash crash. What would that do to our strategy? Because every time we enter a trade, we already have a bracket order as in when we take profit and when we take losses. Just in case I'm in a jungle, I don't have internet. It's still said and done in that reason, right? Would that be the best decision? Sometimes maybe not, but we take that control out of our hand and really believe in our research. We hope the index don't move too fast, but if it does, we already have a lot of plan A, B, C, and we know what to do, and we already know how to deploy them to our students as well.
All right. I like how that's said and done. It does make sense on the fact that it could be a bit of a hands-off approach if you're, you got to live your life, right? If you're on vacation or if you're, working a full-time job, you might be some strategies you can look at that would be set and done. I
Mm-hmm.
also like that you mentioned your team and yourself are calling some audibles in different market conditions. Which sort of market conditions do you feel your set and done approach can be most effective? Would it be bullish, bearish, sideways, neutral? What kind of market do you think?
Yeah. So at the end of the day, anyone who's selling option, anyone who's selling volatility, wants to sell when the volatility is high. That means the VIX index, right, is one of the most important things that's tracking the S&P 500 volatility. So if the S&P 500 goes up, generally, the VIX, which is volatility of the S&P 500, will come down. Now, on the other hand, if the S&P 500 drop, usually the VIX will go up because there's more uncertainty, there's more fear. Generally, when people are fearful, that's when you can take advantage of your profit because you can make the same amount of trade, taking the same amount of risk, and getting paid a lot more. So at the end of the day, we wish we sell it when it's high, we collect more premium and all that, but we cannot always be that and always be right, right? And that's where the theta will come in to help us because every day that the market did not change or any day it changed and challenged our position, every day that theta goes by, our position are becoming more right and right. And also in terms of bullish, bearish, sideways always work. Slow, patience, pay off. Bullish, bearish, both work, just not too fast because we don't want the, reasoning. There's a lot more algo trading, quant trading. So they tend to push onto the momentum. And every time there's a bull market, just go 2% per day. Every time there's bear market, they just sell 2% per day, right? I mean, it's okay in that case, but we don't like bigger movements like that. We like the boring thing and just let the time pass and we collect the premium, just like the insurance company.
Let's get into some of the best practices and considerations with the set and done approach. What research do you do on the underlying index in preparation to sell options against it?
We not only read the news, we track the inside trading that's happening. Not the inside trading you guys are thinking about. Is like, Cody, like, can you sneak peek on some of the things that we don't know? No, it's not that. We have tools that we look at all the directors from main companies, whether they're selling, whether they're buying, right? We have the first-hand information. So we tend to think that they might know the company more than us. So if overall is all selling, overall is all buying, we know how they do it, right? If it's just one person, okay, it's one off. But if it's all sell, 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 we probably know the sentiment of that. It's the second thing. And also we use Elliott waves. Some people swear by it, but again, it's just one of the main factors we look at. But the whole idea of Elliott wave is that usually if the ticker or the stock or the index goes up, it's not going to go up in a straight line. Usually it goes up, pull back a little bit, goes back up, pull back a little bit. So you go up one, pull back a little bit, two, pull back a little bit, three, and then usually you reach a cycle, right? Once you go to the top, you kind of come back down a little bit. So one, come back one, pull back, in this case, go back up, come back down two, right? So that finished one Elliott wave. But a lot of time is determining what stage of the Elliott wave you're actually in. And that's a lot of time you use support and resistance to help with that, because we don't really have to track individual stocks, but we have to track the sentiment of the market. So we look at the hedge fund, we look at the institutional, the position they're putting on. We listen to what people say, but we track more of where the money is actually flowing, because money don't lie. They can say one thing, but they flow the other way. So we tend to trust the money more.
All right. Well, yeah, if you can see where that money's moving, I really like that analogy you were saying, where that money's going, and you're following that. Almost like a rising tide raises all ships, or it may fall with the tide as well. So that's really interesting. Since I can pick your brain a little bit more, Cody, I want to know what are some of the factors you consider when choosing a strike price for index options that you write?
At the end of the day, our goal is to sell a credit spread on a very low delta. Delta goes hand in hand with support resistance, and depending on how high the VIX is at that point as well. But a general rule of thumb is I don't go higher than delta of 10. In my opinion, if you're a good trader, you should be taking less risky trades, but more frequently taking profits, right? It's just getting on basis and keep collecting those small wins. Generally, we usually take profit when it's 50%. Our, our goal of making money per trade might be 1%, 0.5%, 1.5% per month, but we make more frequent trades, we close them more frequently, and we're just more right? So based on the technical, based on the fundamental, based on the momentum we're seeing. And a lot of time I'm very hands off, right? I only spent 30 minutes per week.
All right. Well, that covers the strike price and what you're looking at when you're considering a strike price. What about when it comes to choosing an expiration date for the credit spreads that you write? Do you have any rules of thumb to help you decide that?
The closer we are to the expiration day, the more gamma risk we have. You're like, okay, Cody, gamma? Like gamma basically is a fancy word of acceleration of delta. That just means that when you're getting closer to expiration day, the faster the premium will change according to the price action. Like I said earlier, throughout the entire webinar, we like to be lazy. We like to be patient. We don't like too much of that up and down. We're not in for the adrenaline. I'd rather be boring and like 20, 21, 22, right? So we tend to write it further out, right? Could be between 30 days to 60 days, and that's when we find that we have a good curve of the theta start getting steeper. That means we're collecting more premium per day. By the same time, we're not running into the gamma issue. Even if the SPX or the S&P 500 bounce 2%, my P&L might not move more than 10-20% on that trade in terms of premium. So that's what I like to see. And we try to close out the position before, 2 weeks before expiration, because before 2 weeks into expiration, that's when it gets very volatile. Every price movement can really change the premium. A lot of time, people who are not well trained or even well trained people can get emotionally attached to that. So we like to write it further out and close it a lot earlier.
Okay. Would you have an average time frame that you usually like to look at for an expiration date, Cody? Like, would it be more in, the several months, or would it be like in a 60-day range or 30-day range, anything like
Yeah,
that?
30 to 60 day.
30 to 60?
Yeah.
Now, you mentioned the idea of rolling an option, and you do a lot of credit spreads. So, how do you decide in this case when to roll a credit spread up or down?
The easiest way to roll is when the ticker's price is still out of the money. As in, your position might be challenged, but it's not yet crossed your strike price yet. Because the moment it crosses your strike price, you're playing a losing game, right? So a lot of time is when they're certain distance away, you start rolling it, buy yourself more time or buy yourself more room up or down. And that's where we found it's the easiest to roll. And of course, there's like we can get into like, hey, how wide is your spread and all that. It can all play a game, right? The wider your spread, the easier it is to roll. The closer your spread, the harder to roll, right? There's
Right.
certain rules in that.
Okay. Well, you're reminding me as I'm getting older, it's like we like to take a little bit less risk, I think. At least I do anyway. As I'm getting older, not as much of that roller coaster like up and down you'd said.
No.
So I like the idea of that set and done, and then also this being able to roll and managing risk that way as well. So thanks for that explanation. Also, I want to thank you for the fantastic considerations you've shared for trading credit spreads, especially using those index spreads you've mentioned. And if you're interested in hearing another trader's perspective, you can watch our webinar, My Approach to Trading Options Without a Lot of Money. So as always, it's in the Learning Center and in YouTube. All right, so we've heard a lot about Cody's approach to trading credit spreads on index options. So let's take a moment to hop into Advanced Dashboard platform in WebBroker to put those considerations into practice.
So you can use any index you can find. So if you want to use the Dow or the S&P 500 or any other indexes, this is one that Cody had mentioned. This is a fraction or a tenth of the S&P 500. The S&P 500 would be at around 4,112 at the moment. You can see that that's showing as 411 for this particular index. So remember, this is an index where it's going to be settled in cash when you're trading these options. So what you want to do is you want to make sure you have the symbol. So this one is semicolon XSP to get this mini-based SPX or S&P 500. And you're going to want to go from the single leg order over to the multi-leg order. So I'll actually demonstrate that. So when you originally start on the option chain, it's going to look like this, and you're going to see all the dates showing with the expirations in the brackets right beside it. And then you're going to go to multi-leg order. And this is where you're going to be able to set up. You're going to see this custom strategy underneath. This is where your order is going to be established. And you're going to have to go just down below, and you can see as I'm scrolling, I can look at May 11th, May 12th, and so on. I can see the dates to expiration. These are going to look a little bit different because this is an index. They have much more frequent expirations. You can see there's the 0 date till expiration. There's 1 day, 4 days, etc. So you want to decide on your expiration. Let's choose 5 days as an example. And we can scroll down along within the chain. If we do a credit spread with puts, we are going to look at down here, we're going to go scroll closer to the at the money price just to see where we're at. So you're going to have to scroll down a little bit further. If we get close to this 411, you're going to see that the shading changes just to show the in the money and the out of money options on both sides. And then what I would recommend doing is you can change the view on here. This is showing the basic view. The bid and ask will stay the same, but we want to see some other information related to the Greeks that Cody had mentioned even as well. So if we click on the Greeks, and Cody had mentioned that he does like to look at a delta of around, I think he was saying about 12 or so. So those would be more of a really low risk strategy. So you can see there's like a 12 Greek. You can choose whatever you prefer, whatever you see fits. And let's say we can see 58 cents is on the bid. So what you want to do is establish that first leg. So remember, with a credit spread, you're going to sell the first leg on the put. So if we do that at 56 cents, and then you can look at a range you want to establish if you wanted to do a 2-point spread or it could be 5-point, whatever you prefer. Let's say if we do just maybe a couple points here, let's go to 399. So that would be 3 points. We're going to click on the ask. Okay. And there you go. That's establishing. It's showing you what you have. You have a bull put spread. You can see your maximum profit. Not a lot of premium on this particular one. It'd be $20. So you could potentially go with a little bit of a higher delta if you're thinking that's something that makes sense. So we did 12. You could even, if you think you wanted to go to 20, and you can see the premiums go a little bit higher, or 25. Remember, delta is a good indication of that percentage chance that these options are going to go in the money. So if it's around a 23% chance that this $406 put could end up in the money and you could be assigned on that leg. And as Cody's saying, if you're just getting those small amounts and you have very, very little risk of that assignment on this particular strategy, then you could do that over and over again, and it's going to add up. It's definitely going to build on its own, or have that snowball effect for sure.
All right, we're going to have to leave it there. Thanks again for taking the time to share your set and done approach to trading options, Cody. Any final thoughts you'd like to offer our viewers?
If you're starting something new, start with a smaller account, whatever strategy you're using, and then keep trying on it. When it's working, then you start scaling your account. But don't start with a big account if you don't know what you're doing, because a lot of time you think you know enough. You just might know enough to be dangerous, and you might get hurt really bad. But if you're learning from the right person, if you're getting the right resource, you can actually save a lot of money and time. And whoever, that's up to you to decide who that person or that resource is. And there's a lot of free resource out there, and you can always do your due diligence. But for someone just like, you know what, Cody, I don't have a lot of time, and you're like Brian's, I don't want a lot of risks. I'm getting a bit more mature. Yeah, uh, setting that strategy could be something you can look into.
Yeah, one of our frequent webinar guests, Tony Zhang, a long time ago, I watched one of his webinars and he said, you want to have enough powder in the keg to fight another day. So I think he's a military buff or a history buff or something like that. So I really like that one. That hit home. So you can use that rule in terms of if you're thinking, is this trade a little bit too big or am I risking too much? You can ask yourself that question. So thanks again for joining us. I really appreciate it, Cody. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.